The Federal Reserve is widely expected to raise rates by 25 basis points on Wednesday, and the decision will be followed by a news conference from Fed Chair Jerome Powell. Central bank watchers will also be keeping a close eye on the Fed's update to its economic forecasts. Joining me down the line from London is Andrew Mulliner, Portfolio Manager at Janus Henderson. Andrew, thanks so much for joining us. Simple question to start with. What are you expecting from the Fed on Wednesday?
Well, as you said, they're widely expected to raise rates, and we're expecting them to raise rates as well. It's been very well telegraphed in advance, so that's really the main event. But of course, the more interesting parts for most of the market will be actually the forecast that they release at the same time, and then also any communications around how they see their current level of policy accommodation as well.
So how many rate hikes do you think the Fed will signal for the years to come, and how does that compare with your own expectations?
So, I mean, for the rest of this year, they're clearly likely to signal another rate hike in December. And then for 2019, we're thinking like 3 or 4. So, frankly, the market is already well on its way to pricing towards that. It's definitely not all the way there, though. But perhaps the most interesting part of this press conference, or rather the release that goes with it, will be the longer-term neutral rate released via their dots plot. So if we see an increase in that, that could be quite meaningful for the markets in terms of where levels, yield levels might set longer term.
So do you think the risk is that the Fed surprises more on the hawkish or the dovish side?
Certainly at this point it's to the hawkish side, I would expect. That said, the market is pretty well lined up for a more hawkish Fed, albeit a moderately more hawkish Fed. But certainly, given all the data we've seen from the US, it would seem highly unlikely that we'd see a dovish surprise at this point.
And what are you anticipating in terms of the market reaction to the Fed this week? Are there any assets in particular you'll be paying close attention to?
I mean, clearly it's going to be the Treasury market mainly. Certainly the dollar as well might well key off a more hawkish Fed, at least more hawkish relative to expectations. And then, of course, you know, depending on the magnitude and the size of the moves in the markets, we might expect to see something in the risk assets as well. But primarily, we'll be focusing on treasuries and seeing exactly how the curve moves with respect to their forecasts.
So you mentioned the curve there. So do you think the yield curve is going to invert anytime soon, and should we be worried?
Well, certainly, if you look at, it depends on which part of the market you look at. If you look at the swaps curve, it's already close to inverted, if not inverted, in forward space. So that is, if you look at the curve here, or the curve's forecast for interest rates 1 year into the future, 2s10s are already inverted. So you could say that already the expectation in the market is that the curve will invert relatively soon. That said, in the Treasury space, we're still a little ways off curve inversion. The reality is, history tells us that the curve does invert at some point as the Fed continues to hike rates. Whether that's in the next 6 months, next 2 years, it's much harder to say. Our expectation is it will probably invert sooner rather than later, just given the way the market has responded so far to the Fed's hiking profile.
All right, thank you so much for your time. That was Andrew Mulliner, Portfolio Manager at Janus Henderson. Thank you for watching IGTV, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis and expert commentary.